Have 2 cups of coffee.
2 cups of coffee. Well, I'm ready for my. Hey guys, this is Ted Bogert. We're back with Mortgage Matters with my dear friend, the amazing and talented Kevin Roller with LeaderOne
Morning.
Roller Mortgage Team. Good morning. How are you doing, my friend?
Starting my second cup.
Second cup. I have ice water, and for y'all that don't believe that, it's absolutely true. It's just happens to be fruit infused ice water right now.
Oh, nice.
I know. Citrus Club, they do a good job with that little water scenario. So it's been been a little while. We both had stuff going on and traveling and all of that. Of course, I had the storms here for a little bit. Hopefully, that's over for the year.
Yeah.
So, Kevin, tell them just a teeny bit about you before we dive into 3 topics that I am interested to hear your take on.
Absolutely. Kevin Roller, LeaderOne Financial, 24-year veteran. Just all things lending. So real estate, 1 to 4 units, everything from conventional to government loans, government being USDA, which is good for your area,
Yes.
VA, which is also good for your area, FHA, which is great for first-time home buyers with the lower FICO. That goes all the way down to a 500. So does VA.
Say that again for the people in the back. That goes all the way down to a.
So both FHA and VA allow for as low as a 500 FICO score. So most lenders don't do anything below maybe a 580 or 620 or 640. It's called an overlay. It's an additional requirement on top of the agency's guideline. So if the government allows it, we allow it.
Yes.
So we do not have any overlays on top of that.
It's amazing.
And then of course, anything also non-QM. So that would be debt service coverage ratio, bank statement, profit and loss, different programs like that as well. So really anything residential, second loans, second home equity lines of credit, second liens, all that. So fixed rate, second
all. And we're not afraid to do it, which I was having a conversation with one of my realtors this week, and they're like,
down payment assistance.
What's that? Down payment
assistance. Yeah.
Yes, and we're going to talk about that.
Okay,
but
good.
a lot of companies say that they do all those things and they may have access to them, but we're not afraid to take a look at it. Which let's talk a little bit about. We have a bank statement loan that we've got.
Yeah, so we've got a couple different bank statement programs out there. So, but basically, it's personal bank statements or business, and then it's either 12 or 24 months average. So we can, for somebody who, like, for example, we have clients all the time that send their tax returns, and maybe they have, like, we had one guy that had $4 million in gross receipts, but he showed $100,000 in taxable income.
Right.
Now, the truth is somewhere in the middle, because he wrote a lot of things off, maybe that he was allowed to write off that reduced his taxable income that was really income.
Yes.
For example, you can write off depreciation, and it's an expense that didn't really exist, right? And so if you write off $300,000 in depreciation, it reduces your taxable income by $300,000, right? Now, we can add depreciation back in, but I'm just throwing that out there as an example. So when you do that and you reduce your taxable income that you're paying to the government, lenders have to go off of for conventional financing and government financing. We have to go off the bottom line. We can add back in certain adjustments like depreciation to your bottom line income, but we can't show it as $4 million, right?
Right.
I mean, in that case, the guy was $400,000, which is great. But it wasn't enough to debt to income ratio for the $5 million home he wanted to buy, right? Which
Yes.
At his income level, he could really afford it, but his taxable income did not.
Right.
However, his bank statements showed a different story. They showed tons of deposits. And so we take a factor of those deposits, count that as the income, and he ended up qualifying. So the bank statement program helps the astute self-employed person that pays very little in taxes.
Right. And that's why they become, a lot of them are self-employed or do their LLC or whatever they do, self-employed filing, because they want all those write-offs. So that it does look like they can't really afford a cup of coffee at the end of the day, legally, of course, y'all. And so
that's a great like non-QM product. So what non-QM means is it's a non-qualified mortgage. So back in 2008, 7 and 8, really 9, they started passing legislation, the CFPB, about what a QM mortgage is and a non-QM mortgage is. And,
yes.
And a qualified mortgage is really a mortgage that's done with a conventional loan or a a government-backed loan, a GSE loan.
Yes.
So anything else is really non-QM. And back in the day, they used to call it subprime. It's not really subprime anymore because they're not doing like crazy low FICO scores with adjustable rate mortgages that people, it's changed,
Yes.
but it is non-QM. So
We have that, and you're good at it.
yeah, it's tough. A lot of people don't do it, but I always say if it's not 10% of your business, you're probably not giving your clients the best service because you're likely turning people down that could qualify for a product like DSCR. We have a client I was able to help yesterday. They did not qualify conventionally. They didn't qualify government wise. And really for the government products, the VA, the FHA, the USDA, those are for primary residences, right? So this client started by saying, "Hey, could I maybe live in the home?" I'm like, "You could, but you don't qualify."
Right.
He just didn't qualify. But he did qualify for a DSCR. So the debt service coverage ratio, there's different kinds. The easiest way to explain it is the rent has to cover the mortgage payment.
Right. That's the simplest way I've ever heard it put. You're right.
Yeah. So if the house payment's $1,200 a month, the rent has to be $1,200 a month or more. So the higher the rent compared to the house payment, so if it's $1,200 and the rent's $1,800, that'd be like a 1.5 DSCR. The better your interest rate, the higher loan to value you can go. So there's different. It's a sliding scale. The lowest interest rate is going to be really a 1.25. So the rent has to be at least 25% more than the house payment. So if it's $1,000, you want $1,250 for rent, and 20% down and a 680 FICO or higher. You're looking at the best rate out there, which is like 6.5 costing 2 points. It's not awesome, but it's not horrible for a DSCR as long as you're cash flowing, right? You're buying an investment property. And then down payment assistance. So this is switching gears because down payment assistance is for that first-time home buyer. I don't think a first-time home buyer is doing a DSCR loan. They may be doing a bank statement loan. But first-time home buyer, man, you guys have a great product in Orlando.
We do.
The Florida housing right now, they've got rates of 6.5%, giving $10,000 towards down payment or closing costs. So the way that works is it's not a grant. It is attached to the home for forever until you sell the home. You do eventually have to pay it back. There's no payment on it if you're under a certain income limit, and it's a sliding scale based on the county. So let's just say somebody were to buy a home for $250,000 and Florida housing gives them $10,000. They never have a payment on it, but if they were to sell the home 10 years from now, they have to pay Florida housing back that $10,000. So it's not an expense because it's equity in their home. And when they sell the home, they're just giving that portion of equity back to Florida housing to help future homeowners. But Florida housing has a lot of programs. They've got the bond program. They've got the Hometown Heroes, which is out of funds right now. And then they also have they call it a TBA. It's where they give you 3%, 4%, or 5% towards your down payment. And depending on how much you take, the interest rate goes up with their program, right? So you can start with 3% at 7.35%. So you're better off if you have your own down payment, but it helps that first-time homeowner that doesn't. And the reason you would do that is so that you can immediately lock in the sales price, right? Because a $250,000 home next year, their forecasting is going to be $250,000 to $260,000 because it's going to go up.
Yep.
And while a 1% reduction in interest rate saves you a little bit of money, it doesn't save you as much as $30,000 added to the sales price does. Correct. So it allows that first-time home buyer that's like, oh, I'm going to wait to save up money, and a year from now, hopefully I can buy a home. Well, a year from now, your payment's going to be higher, even if the rate's lower, because the purchase price is going to rise. There's going to be just more competition coming into the spring.
Yes.
More homeowners looking to buy, more pent-up demand from people that did not sell their home and move up. Right. So that's going to be competition. There's just been people on the sidelines that are waiting for rates and now they can't afford to anymore. They're like, I'm going to buy. Right. The rates are great right now, to be honest. I mean, if I was going to say, I don't know, the 30-year average rates over 7%, we're at like, call it 6.5 was the Freddie Mac publishes the rate that was given out for the last week. They take a blend of, and it's a government reporting it over all the lenders across the United States that did a conventional loan, and the average homeowner got 6.54% last week. So that's a good indication of what the rate is, 6.5%, right?
That's awesome. That's awesome. I think people forget what we were dealing with just a year or so ago.
Well, we were over 8 for a hot minute. I mean, yeah. So, and it dropped below 6, high 5s, and then the Fed came out and dropped rates. And what happened to mortgage rates? They went up. So don't wait for the Fed to drop rates to buy, because they're not.
There's so many people. There's so many people on the fence right now. I mean, we have, you and I both have pre-approvals in there, and I just feel like everybody's in this waiting game. Get past the election. Well, you get past the election, and then you're into the holidays. And then 2025, like you said, I think we're going to see some big changes in the spring.
So they are forecasting right now that the rates will lower in November. That is the forecast. And so what happens when rates drop? For every 1% the rate drops, and I hope it drops 1%, that'd be great.
Yeah, it would.
1 million more people enter the market. 1 million more people qualify to buy. 1 million more people are going to be in the let me get pre-approved and let me go make offers stage.
Right.
When that happens, it pushes the price up. There's demand. The demand increases, right? So, and the supply hasn't changed a lot. It's increased a little bit in your market, which is a good thing. But if 1 million more people enter the market, there's not enough supply. So,
right.
So I would say that I love people that are getting under contract right now, and we're just floating them past November. We'll just lock the rate in November so that they get the best rate possible. We also have the ability to, if somebody's like, I don't want to do that, we can lock them in. I can lock them in at today's rate. Let's call it 6.5%. And then rates drop to 5.75% November 15th, let's say, a couple of weeks after the election. Then I can float the rate down to whatever the current rate is, right?
That's cool. That's really cool. See, that's why it's so important for you to get your application in and then have a brilliant conversation with the brilliant mind of Kevin Roller.
Well, and there's something to, like, I was talking to a client this morning who was on the fence about buying, and I didn't, I was very nonchalant with her, but I wanted to be like, I wanted to say, like, you need to buy now. Like, my passion's like, I want to, like, but I didn't want to come across like, I don't know, pushy or salesy or whatever. But in my mind, I'm like, why would you wait? Because the appreciation that you're going to miss out on, the principal reduction that you're going to miss out on. And if you don't know what I mean when you buy a $300,000 home and it appreciates 5% over the next year, you made $15,000.
Correct.
And when you buy a $300,000 home and you pay it off over 30 years, that's 25. What is that? Sorry. 300.
You're going to do math.
I am. 300. I mean, it's 10,000 a year, right?
Right.
30, that's $10,000 a year on average in principal reduction. So that's $25,000 a year that you make.
Yep.
It's wealth. It's not cash in your pocket. But let's say the house payment on that $300,000 home is $25,000. What's the net to you? Break even. It's break even. You spent 25 and you spent 30 and you made 30.
Right.
Right. So why pay rent of $2,000 a month or whatever it is? Because you don't get any of that back. You build no wealth. There's no principal reduction. There's no appreciation. And when she waits to buy next year, that $300,000 home is likely going to be $330,000 to $345,000.
That's right. Words of wisdom, my friend. Thank you. All right. So we covered DPA, down payment. We covered bank statement. We covered interest rates. And we covered have a question or have a particular type loan scenario you want to run by us, please make sure you reach out to me and I'll get you to Kevin and we'll get you the answers. Kevin, always a blessing to have you on the program. We'll see you guys next week.
Thank you,
Mortgage
sir.
Matters, right? Bye, guys. Yep.